Sounds good. Okay, we are now live. We will be starting promptly at 12 p.m. today. So folks settle in. Please be ready to kick off at 12 p.m. Grab that final cup of coffee or water at this late stage of the morning. I'm still drinking coffee, but take that last minute restroom break because we will be starting promptly at 12 today. To the San Diego chapter of the CCIM Institute's September 2nd Lunch and Learn. We are delighted for you to join us on this beautiful morning here in sunny San Diego. It is sunny out there and definitely a beautiful place. I'm Doug Tabor, VP of the CCIM San Diego. You may know me as a rental housing realtor here in San Diego County. I am with Keller Williams, KW Commercial. My co-host this morning is fellow board member, Ms. Paris Moe. Paris is a sustainability coordinator at Verdani Partners and recent graduate of the USD MBA and Masters of Real Estate program. How are you today, Paris?
I'm doing well. Happy to be here with you. Thank
Awesome.
you, Doug.
We're grateful for your participation. You're always, we're very, very happy to have you here and participating. And now for a few housekeeping items. See the slide pop up. Attendees are in listen-only mode. You are welcome to chat with each other using the chat box. If this is your first Zoom call, you can find the chat box towards the bottom of your screen. Please use the Q&A box to submit questions. So we will be accepting questions, and our speaker today, I will tell you firsthand, loves complex questions. So if you have complex questions, Bill Exeter loves those, and we will be accepting those questions live. We've also had some questions that were submitted prior to the event. So a lot of questions, which really make all these events much more exciting each time because it makes them different. This webinar is being recorded, and a copy of that recording will be shared after the event. It is being recorded, and you will receive an email for the recording of it after the event. And then also you can use Zoom reactions by clicking chat and using the toolbar at the bottom of the screen there. So you could certainly react using Zoom with hand waves and other fun things. We will be concluding at 12:55 p.m. Again, we're going to have one speaker today. We are going to really open it up for Q&A across the board, but really open it up towards the half of the hour, and then we will be wrapping up at 12:55. And now, a little bit about CCIM. In case you were wondering, CCIM stands for Certified Commercial Investment Member. Our membership is made up of commercial real estate professionals from really across the globe, around the world. The CCIM lapel pin, it's on one of these sides. This side, here you go. CCIM lapel pin denotes the wearer has completed advanced coursework in real estate economics and investing and demonstrated proven industry experience. There's also a big 6-hour test wrapped up at the end, which I'll tell you firsthand, it is a beast. As the local chapter, we do focus on education and networking events such as this one, and we really want to promote excellence, competency, and collaboration. That's what we're all about, excellence, competency, and collaboration. If you want to learn more about becoming a CCIM yourself, as designee as we call them, or how to follow more of our upcoming events, you can certainly check into our chapter website, which is ccimsandiego.com. Again, ccimsandiego.com, or go to our new LinkedIn page and follow us there. All this information will be included on emails that come out after the event. Now, if I may, I'd like to take a moment to really thank our generous sponsors for 2020. Groups like ours are really thankful for the sponsorships that we have. Our platinum sponsors include Chase Commercial Lending, Hecht Solberg, Marcus and Milchap, Marsh McLennan, Procopio, and Savills Global Real Estate. Our gold sponsors are CoStar, Exeter 1031 Exchange Services, Lankford and Associates, Pacific Medical Buildings, Slat Capital, and SCS Engineers. Again, we really thank you for your continued support, especially in this crazy year we're calling 2020. Thank you. And now we're going to take a moment and do a poll. We always like to find out who is in the audience. So I'm going to ask Paris if she can go ahead and deploy the poll and let us get an idea of, now you know who we are, let's get an idea of who you are. Paris? All right, the results are coming in. And the question on the poll, of course, is what role do you play in San Diego commercial real estate industry? We have owner investors, developers, lenders, property managers, attorneys, and other. Okay, we'll give it a couple more seconds and let's go ahead and put forth the results. Okay, 35% owner investors, 6% lenders, 41% brokers, and 18% other. I wonder what the other is. We'll have to maybe do a poll later on what that other is. So it's good to have everybody. Thank you for being here. We're delighted again to have you participate. Really, it's going to be a great presentation this morning. And so now it's really my pleasure to introduce our speaker today, Mr. William Exeter. Bill Exeter is President and CEO of Exeter 1031 Exchange Services and the newly formed Exeter Trust Company. Known as a leading expert in the industry, Bill has been in the fiduciary services industry since 1980. He specializes in real estate and tax strategies and self-directed IRAs, which he's going to be discussing this morning. Please give a warm yet personal welcome to Mr. Bill Exeter. Bill, how are you?
I am good. How are you guys?
We are fantastic. We are really looking forward to your talk. This is a subject that a lot of folks have interest in, probably why we have so many brokers on this morning. So really, without any delay, Bill, I'm going to pass the floor to you, and we look forward to your talk.
Terrific. And I hope you're seeing the large PowerPoint presentation and not the smaller screens. Do I have the right one shared?
Looks like a large one on my screen.
Perfect. Well, we titled this Unraveling the Mystery of 1031 Exchanges, and this one is Unraveling the Mystery of Self-Directed IRAs for the same reasons, which is there's just a lot of information out there where investors will call 3 or 4 people, get 3 or 4 different answers. We'll get the question, you know, I'm so confused. What really matters? What are the real issues? And, you know, self-directed IRAs, there's a lot of opinions out there. And that's the problem, is you'll ask a question and what you're really getting is an opinion, but it sounds like fact. And so it gets really confusing as to, well, what's really the issue? So having said that, let's get started. And again, I want to encourage questions as we go. So feel free to plug away if you have any questions. The first thought, I get a kick out of this because people call this a self-directed IRA. Really, all IRAs are self-directed because the owner of the account actually chooses where to put them. And whether you choose to put it at a commercial bank like a B of A, a Wells Fargo, etc., whether you choose to put it at a brokerage firm, you know, a Charles Schwab, a Fidelity Investments, whether you choose to put it at a trust company like Exeter Trust, you're choosing where to put it. So they're all really self-directed IRAs. So having said that, the real issue is, what does the IRA provider allow the investor to invest in? That's what really differentiates this. So the industry over the years has kind of defined self-directed IRAs to mean or refer to IRAs that allow things that are not publicly traded. People call them special assets, alternative assets, non-traditional assets, things like that. But it really boils down to, what does the IRA provider allow? And you know, the traditional wirehouses and brokerage houses are set up for anything publicly traded. Banks are set up for depository type accounts and things like that. If you're going to a life insurance company, you're getting some type of an annuity, but you're limited to what those products, what those providers allow. The true, if you will, self-directed IRA would allow a lot more than that, where the investor can choose from virtually any type of investment out there. There's not a whole lot of limit on what you can or cannot do. So that's really kind of some general comments on self-directed IRAs. Just keep in mind, they're all self-directed. It's really about what do you want to do as the investor, and then from there, choosing the right component parts that make sense for you. So this is kind of a list of the more common types of IRAs that are out there. And I think this is probably pretty commonsensical, but I thought I'd throw it out there real quick. So the traditional IRA, of course, is pre-tax. You make a contribution, and if you qualify, you can deduct that in your tax return. So it's typically pre-tax money. Rollover IRA means you've transferred money from some IRA or from a pension or 401k plan into an IRA. So the more common types typically is a 401k or a pension distribution. When you leave employment, you roll those over into a rollover IRA. An inherited IRA, of course, someone passes on and you are probably the child or the grandchild and you inherit that IRA. Roth IRAs are the opposite. It's after-tax dollars. So you're putting money into a Roth IRA. You've already paid tax on it. The benefit is when you retire and you pull the funds out, it's tax-free. Where with the traditional IRA, rollover, or inherited IRA, they're typically going to be taxable at the distribution. So you have to decide which is best for you. Sometimes it's a combination of both. So we're not going to really get into contribution limits and all of that. Today, I'm going to really focus on what you can do with the self-directed IRA, the alternative assets, some mechanical processes, how do you actually do it? And we'll kind of use some real world examples because most of us, I think on the call, are probably all tied to real estate somehow. Then you also have SEP IRAs, which is a simplified employee pension plan, and you have the simple IRAs. So those are really designed for the self-employed or very small company. They want some type of a retirement account for themselves and maybe for a couple of employees. They don't want all of the costs involved of a full-blown 401k or pension plan, so they can look at something like that. And then the more recent one that's become popular is the individual 401k. You've also probably heard them as solo Ks, where it's typically a one-person company, one-person operation, and they qualify for an individual 401k plan. And there's pros and cons either way, depending on your situation and what might work for you. We're not going to cover these, but I wanted to throw them out real quick. So there are the 401ks, the solo Ks or individual Ks. The 403B plan is essentially a 401k, but it's for nonprofits or government agencies. So the rules and regulations are very similar, almost identical. The 457 deferred compensation plan could be, structured as a self-directed account. The Coverdell Education Act, same thing, could be structured as a self-directed account in the health savings account. Typically, the 457, the Coverdell, and the HSAs are, don't have a huge amount of cash positions in them always, so you won't see those as a self-directed account per se. It's usually the plans that were on the prior screen that you'll see structured as a self-directed account. So quickly to recap, traditional IRAs are usually held with a bank or a brokerage firm, and you're limited to publicly traded assets, or if it's a life insurance company, you're limited to some type of a life insurance product. Today, we're going to focus on just what we call the self-directed IRA, which allows you to expand that list of alternative assets that you can actually invest in. So with that, we're going to do a quick poll, and so Paris could launch the poll to find out if you've got a self-directed IRA or not, and then we'll go from there. And we'll give it another 30 seconds or so, and then we'll just see how many people on the call today actually have a self-directed IRA, or they don't have one and maybe are considering one. Okay, why don't we go ahead and wrap that poll up, see what the results are. Oh, 35% say they do, 53% say they do not have, and 12% are unsure. And one of the questions we get a lot of, and it makes sense, but a lot of people that say, why haven't I heard of this before? Why isn't there more information out there? The studies have shown that less than 4% of all retirement funds out there today are in some type of true self-directed account. So most accounts are traditional pensions, 401ks, or brokerage firm IRA type things. So a very small segment of the assets available out there are truly self-directed. There's a lot of reasons for that. Historically, this has been available since 1974. So it's been around a long time. It's just historically, people always assumed back in the 70s and 80s it had to be publicly traded securities. And then slowly people realize, the code doesn't say that. The code tells you what you can't invest in, which are only 3 different items, and we'll cover that in a minute. So everything else is pretty much wide open. So in the 80s, which is when I first got into self-directed IRAs, what you'll find is a lot of people would tell you, especially brokerage firms, that no, you can't do that. It's illegal. It's not permitted, et cetera. Well, it just wasn't known back then that you could do that. And then as it got into the 90s and in this decade or century, they're more labor intensive when you get into the self-directed IRA market. So a lot of the firms, the traditional providers, don't want to get into the alternative assets. Takes more work, there's more liability, et cetera. So because of the labor intensive nature of those type of assets, a lot of providers won't touch it. They're also concerned about what happens if something goes wrong with real estate, and they're worried about the liability. It certainly is a more sophisticated, more involved, can be more complicated structure or strategy. So a lot of people aren't aware of it or just don't want to try it. It's actually not that bad. If you really know real estate, this makes a lot of sense to get your IRA or your other retirement accounts into the real estate market. And few advisors are really truly knowledgeable at self-directed IRAs. Those that have heard of it say, yeah, I've heard of that. I know you can do that. I just don't have a clue how you do that. So that's really why a lot of people haven't heard of this. It still amazes me how many people go, I've never heard of that. So I'd like more information. So this kind of breaks it down for you between a traditional provider and a true self-directed IRA account provider. And you notice on the left side is all the regular IRA type assets. So it's the publicly traded assets that are most common that people are familiar with: stocks and bonds and mutual funds, hedge funds, and things like that. At the banking level, it's the usual money market accounts, certificates of deposit, and whatnot. When you get into the true self-directed, now we're getting into all sorts of other types of assets. These on the right are the most common types you see out there, but it's not an all-inclusive list. There are all sorts of other assets that you can actually get involved with through the self-directed IRA. These are just kind of the most common. If you take a poll, this is the most common or most frequent assets you see in self-directed IRA. So by far at the top of the list, especially for us, since we're so real estate focused, would be real estate. So an actual purchase of real estate inside the IRA or the retirement plan. Any type of promissory note, it could be unsecured, although I wouldn't recommend unsecured notes in your retirement account, although it's permissible. But you typically see promissory notes secured by something. Generally, it's a deed of trust or a mortgage. It could be secured by other assets as well, but that's probably the most common type, is a promissory note. We'll get into why in a little bit. Tax lien certificates, you don't see that in California very much, but in certain states that are tax lien driven, where counties can actually sell a certificate and effectively borrow the money to cover property taxes that are delinquent, can be a very attractive investment, and they're usually statutory interest rates. So some of those statutory rates can be 25 to 50%. So it can be very attractive inside of a self-directed IRA. Then you have all sorts of limited partnerships, limited liability companies, corporations. Most of them are privately held of some nature. It might be a Regulation D offering, something along that line. But those are also somewhat common inside the self-directed IRA. But there's lots of other things. I mean, today you're starting to see cryptocurrencies and other assets that are kind of on the fringe. Probably the most interesting question we ever got, which we declined to cover for obvious reasons, was a gentleman who wanted to invest his IRA funds in ostriches. And his rationale was, I want to invest or buy and invest and hold ostriches in my IRA, and I will sell feathers and the meat and the eggs, et cetera, and make a ton of money. Our response was any asset that can die or run off, we don't want to have a thing to do with. But in theory, it's possible. It could be done. So it kind of gives you an idea of how crazy those ideas can be. So getting into permissible, there's permissible investments, which is almost everything out there. This again is everything we just talked about right now. All of those are permissible inside of the IRA account. And we're going to kind of give you a step-by-step process on how you can buy real estate or how you can originate a note inside of your self-directed IRA. The issue is what can you not invest in inside your IRA, and that's a limited list. There's only 3 items. So since 1974, it has always said you cannot invest in a sub-S corporation, and that's the way people phrase it. It's technically not correct. A self-directed IRA could invest or buy shares of stock in a sub-S corporation. The problem is the sub-S cannot allow a trust to buy into the sub-S, so they lose their sub-S status. And that's actually in the process of potentially being changed. So it's not really an IRA issue, it's actually a sub-S issue. But so sub-S's are one of those items where you'll eliminate. You just don't consider that inside your self-directed IRA. All the other entities, a C Corp, a limited partnership, limited liability company, things like that are permissible inside of an IRA. Life insurance contracts are not permissible. So you can't buy a life insurance policy inside your IRA to insure someone else's life or your own. And collectibles, and there's a list there of some of the collectibles that are the more common. So those are not permissible inside of your self-directed IRA. So let's talk about some of the complexities. I mentioned that doing self-directed IRAs with alternative assets, such as real estate, promissory notes, is more labor intensive. That's really from the provider's perspective. So this is one of those issues that comes up. Under the ERISA code, retirement accounts are required to value all of the assets in the entire account on an annual basis. And the provider is required to file a 5498 with the Internal Revenue Service every year by the end of May that reports the fair market value at the end of the prior year. So December 31st rolls around, and then by May we have to produce a 5498 that says the fair market value as of 12/31 is X. When you get into what we call alternative assets, so real estate, promissory notes, things like that, number one, they're hard to value. And if you value them and do it correctly, they're expensive. And number 3, if you value them, who cares? I mean, it's an IRA, it is tax deferred or it's tax free. So at that point in time, on December 31st of each year, we don't really care what the value is because as the beneficiary of that IRA, there's no tax consequence. We're just required to value the assets. So that's what sets the stage for a conundrum. It's just difficult. What do we do? How do we satisfy the ERISA code, but also have kind of a common sense approach to this? So what's happened over the years is a lot of providers would set the policy where we only require a valuation maybe every 3 years. Or maybe instead of a full-blown MAI appraisal, if it's real estate, we do a BPO, a broker's price opinion. Maybe we can log into a couple different websites, print the various values that are out there, average it, and say, there's my value for the end of the year. So they've taken different approaches like that. The last couple of years, what we've seen is the feds are coming down harder on any institution that is federally regulated. And they are taking the position that if you have a self-directed IRA and you've got alternative assets in that IRA, you must value those assets by the end of each year as of December 31st. Well, that creates costs that are really unnecessary, and it's an effort that really is unnecessary. Until you're ready to take a distribution or you hit your required minimum distribution age or something like that, why would you want to do that? But it is a requirement. So that's where the issue comes up. So the federally regulated institutions are beginning to get tougher on this issue of asset valuations, even if they're hard to value assets. You'll find that a lot of these state chartered trust companies are not getting the same pressure. So it's really the federal regulators and or the FDIC that are coming in and criticizing the banks and trust companies that fall into their purview for not valuing the assets. Those that have a state charter, and that's one of the reasons we are a state chartered trust company, are not getting that type of pressure, so we can have a little more common sense approach to the valuation process. So with real estate, it may be that you get a BPO opinion once a year as of December 31st. We put that in the file, and that's your valuation for that particular year. We don't need a whole MAI appraisal. So that's just kind of painting the picture as to why there's some labor-intensive issues with custodians who offer self-directed IRAs. And the real issue with them is the fact that we have to send out the letter, we have to follow up again and again and again until we get the valuations, and that's what creates some of the problems. So that's why you see a lot of the providers out there not really wanting to jump into this niche. The second area is prohibited transactions. As an IRA account holder, you have to be extremely careful that you're not doing something inside your IRA that is a prohibited transaction. There's really a couple different types. The most common is what we call a self-dealing prohibited transaction. And that is you're doing something with yourself or with a family member, a related party, or something where it's a disqualified party, therefore it's prohibited. Usually it's something where you have a self-dealing transaction, and that a self-dealing transaction will invalidate the entire IRA. Your entire IRA immediately is treated as if it's distributed and becomes a taxable event. So we obviously do not want to have prohibited transactions. And this is one of the areas where it creates a lot of extra work on the part of the custodian in reviewing transactions and pointing out areas where it might be a prohibited transaction. So to review a couple of these, you have an IRA, let's say at B of A, and it's $100,000. You decide to roll it over to Exeter Trust Company. So it's really the same IRA, but you have a brand new custodian. So Exeter Trust Company would be your new IRA custodian, which would allow you to invest in real estate related assets. And then you decide, hey, I would like to borrow money out of my IRA. Well, you're not permitted to do that because it's self-dealing. If you personally benefit from something your IRA does for you, that's a prohibited transaction. Or you might want to lend money to a family member. So your lineal descendants or your ancestors, parents, grandparents, kids, grandkids, that would be a prohibited transaction. You're lending to a related party and it's not prohibited, or it's not permitted, it's prohibited. That would invalidate the entire 1031 exchange. Buying or selling any type of real or personal property from your own IRA. So what we see a lot is somebody will purchase real estate in their individual name and then think, I've got such a huge capital gain sitting here. Maybe I should sell this to my IRA so that when the gain is triggered, I don't have to pay tax on it. You can't sell an asset to your IRA. That's a prohibited transaction. You can't buy an asset from your IRA. That's a prohibited transaction. So you have to visualize the IRA as a complete separate entity, just like a corporation or a partnership or something. And it's got these extra rules where you cannot have any self-dealing back and forth. You can't pledge your IRA for any type of collateral or loan or borrowing or financing mechanism. The fact that you pledge your IRA to a financial institution or to anybody for that matter as collateral for a loan would immediately result in the distribution of the IRA, and it immediately becomes taxable. So we don't want to have any of that. Otherwise, it's you have a huge tax hit. Buying any type of an asset for personal use. So if you buy real estate in your IRA, but you intend to live there, that's personal use. That's a prohibited transaction. That would immediately result in a taxable event. Your entire IRA would become taxable. So anything that you use personally, you do not want to put in your IRA. You have to use personal funds to buy that. So again, to summarize, any type of transaction between you and a related party, so your ancestors, so parents, grandparents, great-grandparents, lineal descendants, kids, grandkids, great-grandkids, etc., those are going to be prohibited transactions and not permitted. The final one is providing goods and services to your IRA, and that's where it gets tricky. Let me advance the slide here. I'm going to put that one off for just a minute. We'll cover that in a minute when we get to a different slide. So here's a quick list of disqualified parties. So we talked about related party and self-dealing transactions. Those are prohibited. They're also prohibited if you're dealing with a disqualified party. So if the IRA is buying and selling an asset or loaning money or one of those things we talked about with or for or to the IRA custodian, that's prohibited. If it's to your spouse, that's prohibited. So anything where it's a disqualified party above and beyond your family members could also be a prohibited transaction. Now, interestingly, in the 1031 exchange world, these are still generally prohibited transactions, or what we call related party transactions, that create issues. In the IRA world, these individuals, the aunts, uncles, cousins, brothers, sisters, nieces, and nephews, are actually not disqualified parties and will not trigger a prohibited transaction. So it is possible to lend to certain family members as long as you're in one of these categories and not a closely blood-related in your either ancestor or lineal descendants. Okay, quick list of parties to the self-directed IRA. So the IRA itself is really going to have just really initially two parties with a third as the beneficiary. So you as the IRA account holder, you're the owner, you're the taxpayer. You choose to roll your IRA over or transfer your IRA to Exeter Trust Company to do real estate related assets. So you're the IRA owner. You're going to have the custodian of the IRA. So you're going to roll it over to Exeter Trust. Exeter Trust is the custodian or the bank for your IRA account itself. So those are really the two primary parties. As part of that, you're going to name, you should name, you don't have to, but you should name a beneficiary of the IRA. So what happens when you pass on? Who is going to inherit that? And so you want to name a beneficiary of the IRA. You can name a primary and you can name successor beneficiaries. So if the primary beneficiary is already passed, you can name successor beneficiaries that would then inherit it if the primary beneficiary has already predeceased you. There's a lot of planning that goes into naming a beneficiary. It's not as simple as just naming a person. That is where you really need to sit down with your financial advisors, your CPA, and make sure you're doing that properly. And there's things you don't usually want to do, like naming your living trust as the beneficiary, because upon your death, the trust immediately has a taxable hit. So generally, you're going to leave it to your spouse, and then if not the spouse, then your kids, et cetera. But I don't want to get into too much detail there because that requires some conversation and specific tailoring for what's right for you. Then when you get into self-directed IRAs, you're going to have a number of other parties involved depending on what your preferences are. So first I want to define what we call a third-party administrator. There's probably, give or take, about 100 truly self-directed IRA providers in the country today. Most of those are not banks or trust companies. They're third-party administrators. So when you're evaluating who's going to handle your self-directed IRA, ask them specifically, are you the IRA custodian, meaning are you the bank? Or are you a third-party administrator? It doesn't mean a TPA, a third-party administrator, is bad. It just means you need to understand what they are, who they are, how they operate, et cetera. Third-party administrators are not licensed, they're not regulated, they're not audited, they don't have any government oversight. Their purpose really is administrative, to help you get through all the documentation to set up your self-directed IRA, help facilitate it, get it done fast and efficiently, things like that. But they're not the IRA custodian. So someone behind the scenes will actually serve as the IRA custodian. And it's important you have full disclosure so you know what all the parties' roles are, who is actually regulated, and who is actually serving as your IRA custodian. And so once you get past that, then you've got the third-party administrators and you have the IRA custodians. The IRA custodian is generally licensed, regulated, and audited by some regulatory or government entity. If you're state chartered, it's usually, in our case, it's the Wyoming Division of Banking. So it's usually the banking commissioner of that particular state. It could be that you're under the Federal Reserve, the Office of the Comptroller of the Currency. You may have a dotted line to the FDIC if you have FDIC insurance, but you want to find out who's the real IRA custodian so you know who's protecting and safeguarding your account. And then decide whether you want to use a third-party administrator or not. And that's really entirely up to you. You just need to know exactly what the parties are. Once you get past that, then you're going to have other providers. So if you are retaining the services of someone to manage your IRA, you may have an investment manager, an investment advisor. You may have a real estate broker who's going to manage the real estate on your IRA's behalf. We'll talk more about that in a minute. You might be investing in promissory notes secured by deeds of trust or secured by a mortgage. So you're probably going to be working with some type of a mortgage broker, a hard money lender, a private money lender. A lot of the hard money and private money lenders use self-directed IRAs to fund or invest in the mortgage loans they fund. So that's how they get their funding pool, if you will. So that's an option. You may be working with a mortgage broker of some type. If you're buying actual real estate inside the IRA, you're probably going to have a property manager to do the active, ongoing property management of the assets inside the IRA. And you may have legal and tax advisors. Certainly you should have a tax advisor that reviews everything quickly. They are the ones that are going to keep you out of trouble from a prohibited transaction perspective. And we're going to talk more about other tax consequences that could happen inside of your IRA at the very end of the webinar today. That's where the CPA can really come in handy and let you know, is this something you should be doing, or maybe you should do this particular asset outside of your IRA. So it really kind of depends, but it's important to have that team ready to go depending on what type of assets you're going to invest in. So let's kind of focus on the mechanical steps real quick. So I want to emphasize, remember that you as an individual do not own real estate, you do not own a promissory note, you do not own a privately held company. You are the account owner of the self-directed IRA. Then you are choosing the investments and you're authorizing the investments inside of your self-directed IRA. And the IRA is actually a separate entity that is making the investment on your behalf through the IRA. So everything you do for that particular investment has to go through the IRA account. There can't be any revenue, rents, income, interest, dividends, whatever it might be that goes from the investment to you personally. It has to go back to the IRA. If there's any expenses involved with whatever you invest in, if there's a capital call from what you invested in, that has to come out of the self-directed IRA. So you have to treat this self-directed IRA as its own individual unit. It's a self-contained unit. Everything has to happen inside that. You can't have any kind of cross-contamination or cross-pollination or whatever term you want to use. You're an individual. Everything you do as an individual stays with you as an individual, and everything you do inside the self-directed IRA must be handled inside the self-directed IRA, and you can't have the two cross-pollinate. Otherwise, you probably have a prohibited transaction. So it's very important to keep that in mind. So first, in this case, we're going to be talking about investing in real estate. And I'm going to kind of walk you through the process. And I think most of us on the call today are some type of a real estate person or real estate background. So I'm going to kind of use California as an example. You're buying real estate in the state of California. We're an escrow-driven state, so I'm going to use escrow as an example. So let's assume that you decide, okay, I want to do this. I want to invest my IRA funds in actual real property. So you've got your IRA at a bank, or you have your IRA at a brokerage firm, and you decide to roll that over to a trust company. You do a rollover process. Now, let me define rollover real quick. I think we touched upon it a little bit, but I want to emphasize this twice. There's two ways to really transfer funds. One is the rollover, and that's the term everyone is used to hearing. Roll over your IRA, roll over your funds, you have 60 days to roll it over, etc. The rollover is just one mechanism. The other is what we call an IRA to IRA transfer, or people call it a custodian to custodian transfer, or an IRA direct transfer. That is the better way to go. That is the preferred approach, and I'll explain why. So let's say you've got your $100,000 IRA at Bank of America, and you want to roll that over or transfer that over to a trust company so you can invest in real estate. If you do a rollover, that means Bank of America distributes your IRA, distributes your cash to you. You actually receive a check. You take that check and you're going to deposit that into your bank account. Now, that is a distribution. That is a reportable event. So at the end of the year, Bank of America is going to report that on a 1099-R that shows you had a distribution from a retirement account. You then have 60 days to roll that over into a new IRA at the trust company. Now, the IRA is going to be receiving that $100,000 in the rollover as part of the rollover process. And at the end of the year, the trust company is going to report that as a rollover of $100,000 on a 5498. So in that tax year, you should have a 1099-R that shows a distribution of $100,000. And the same tax year, you should have a 5498 that shows a rollover of $100,000. They net to zero, so there's no tax consequence. However, the problem is there is room for human error in that process. That's number one. So if any of that reporting gets messed up, it creates a nightmare trying to get it fixed with the IRS. So we try to avoid rollovers for that reason, because an IRA to IRA transfer is not a reportable transaction. B of A would transfer the funds directly from B of A to the trust company, and the trust company deposits them into your IRA account. There is no distribution. It doesn't go through you as an investor, so there's no reportable transaction. The second reason is you're allowed one rollover per year, period. That's not a lot in the event you need to do a rollover. The IRA to IRA transfers, there is no limit. You can do as many of those as you wish because you never touched the funds. So as we're doing these things, always do an IRA to IRA transfer that avoids the human error issue on a distribution process, and it does not take away that one rollover limit per year. So the rollover I reserve in the event you have an emergency. If you have something that occurs in your life, or an investment that becomes a rush and you have to get it done by tomorrow or the day after, those situations is where you'd want to go to your current custodian, get a check, deposit it, and roll it over to the new IRA, because you have control of the process and you can expedite it. So those should be limited to emergency situations where you have to either respond to a disaster in your life, medical, what have you, or do a very quick turnaround. Otherwise, always do an IRA to IRA transfer. Having said that, so now you've got your transfer done. The account has been transferred to the trust company. Exeter Trust Company is holding your funds in your brand new IRA account. So really, I shouldn't say brand new. It's really the same IRA. You've just transferred it to a new custodian. So you have a new IRA custodian, but same IRA. And now you're ready to invest in real estate. So you can go out, you go shopping, you find the real estate asset you want to acquire. At that point, remember, you're not the buyer. The IRA is the buyer. So anything you do, from making offers, executing contracts, opening escrow, etc., has to be done under the name of Exeter Trust Company as custodian of IRA number, blah, blah, blah. There's little variations there, but that's effectively what you use. That is the legal designation of the IRA. That's the entity. The entity itself, the IRA, is a trust, and trusts do not have legal capacity by themselves. So you have to have a custodian that has legal capacity to execute on behalf of the IRA. So Exeter Trust Company as custodian of IRA number, blah, blah, blah. You can add for the benefit of John Smith or your name, whatever, if you want to do that. Some people love to have their name there for the benefit of. Other people want confidentiality and don't want others to know that their IRA made this investment, so they leave the for the benefit off. So whatever you choose to do, you find the property you want. You make an offer. The offer is under the name of Exeter Trust Company as custodian of IRA number 12345. Exeter Trust Company will take that contract, get your authorization to execute it. We will sign it as officers of the custodian. So it's very important that the custodian is the buyer, is making the offers, et cetera. You can negotiate and all of that, but anything that is executed, any contracts, any escrow documents need to be in the name of the trust company as custodian of the IRA. That is critical. Otherwise, you run the risk of a prohibited transaction. There are a number of attorneys who are concerned that, well, I should back up. One of the questions we get a lot of is, what if I already have a property under contract and I decide, wow, this would be a great investment for my IRA? Can I just assign that contract to the trust company, or effectively to your IRA? The answer is you really don't want to do that, because that could be construed as you personally or your IRA benefited from that self-dealing, and that could be interpreted as a prohibited transaction. It depends on the fact pattern, et cetera, so I would just avoid that. So if you find yourself in that position, the best case scenario, provided it doesn't provide or cause any other issues. Terminate the contract, throw it out, rip it up, start over, brand new offer, brand new contract under the name of the custodian for the benefit of your IRA. That is critical. So now we're going through the closing process. Everything you do through that closing process, any of the escrow instructions, any amendments, any addendums, again, are in the name of Exeter Trust Company as custodian of. Anything else you do in that escrow closing process should be under the name of the trust company as custodian of your IRA. The deed will be deeded, from the seller to Exeter Trust Company as custodian of IRA number, blah, blah, blah. The preliminary title report and the title insurance policy would be in the name of the trust company for the benefit of the IRA. So I've kind of beat that one to death, but that's one of the areas we see where problems come up all the time because people think, well, it's my IRA, so if it's in my name, it doesn't matter. And it could be a huge problem. So it's very important as you're going through the process that all of this is treated as if it is your IRA.
So it seems we received our first live question.
Okay.
Could you answer for us? What is the annual maximum amount a self-employed person can contribute to a traditional IRA? And what is that in contrast of a self-directed IRA?
The contribution limits for IRAs versus self-directed IRAs are exactly the same. So you still have the exact same contribution limit, $6,000 for the year, or if you're over 55 years of age, you can make the excess contribution or catch-up contribution, which is an extra $1,000 on top of that. So that would be for your traditional IRA and your Roth IRA. Then you also have, your SEPs and your simples. Those are generally a percentage of your income. So that where your CPA would have to sit down, calculate the income and how much you can contribute to those particular IRAs.
Thank you.
You're welcome. Next, and we just got a couple more slides and we're getting close. So if there's any other questions, go ahead and post those. And then I'll wrap this up and we can take any questions that might come up, or I can be happy to answer questions later too. So we get a lot of questions on, okay, so I've decided to do this. Should I do this investment inside of my IRA or should I do it outside of my IRA? And that's a really important question. There's benefits either way. So, and there's no black and white answer. This depends on what's right for you as an investor. So number one, you got to look at the risks. If you buy real estate inside your IRA and something happens, a slip and fall, whatever it might be, your IRA is the owner. So if there's a lawsuit, they're going to sue the trust company as custodian of your IRA. They're effectively suing the IRA. So you have to take the risk factor into consideration. There's also tax factors involved here. So if you have a piece of real estate in your individual name and you go to sell it, you probably are going to get capital gain treatment. If you have a piece of real estate in an IRA, it's not going to be capital gain treatment if it's a traditional IRA. When you retire and pull the funds out at retirement, it's going to be ordinary income. So if you do it inside the IRA, you're converting everything in a traditional IRA to ordinary income. If you do it outside the IRA, you get capital gain treatment. So you really have to look at that and go, which is better? If it's something like a promissory note, mortgage, deed of trust, et cetera, those are always going to be interest income. It is always taxable as ordinary income. Those make perfect sense to put inside of an IRA. That way it's either tax deferred or tax free. So you have to look at the future kind of income tax computations. Real quick, these two topics get really complicated, so I just want to throw them out there. The investment inside your IRA should be passive. It's very important. It's a passive investment. If you have a non-passive or what people call active investment, if you buy real estate in your IRA and you're managing the property and you're doing all the work and you're doing all the maintenance and you're collecting the rent checks, you're probably considered running a business, a real estate business out of your IRA. And your IRA is probably going to have to file a 990T, which is what they call UBTI, unrelated business taxable income. And your IRA may actually have to pay taxes. And I'll tell you, the IRA gets taxed at the trust rate, which is the highest rate out there. So be very careful with that. Anything you do should be passive. Have your IRA make an investment. You can manage the manager, so hire a property manager to do the work for you and manage the manager, but the property manager should do all the work. The offset to that is debt. One of the questions we get a lot is, can I buy an asset inside my IRA and can I leverage it? Can I finance it? So probably the most common example is I'm going to buy real estate in my IRA. I'm going to have my IRA put 30% cash down. I'm going to get a 70% loan to value loan. Can I do that? The answer is it depends. And I see Doug laughing. That's my favorite answer, is it depends. Number one, your IRA cannot benefit, and you personally cannot benefit from each other. So you can't have that self-dealing. So if you get financing inside your IRA, it has to be non-recourse. If it's not non-recourse, that means you personally are guaranteeing the debt. You have an automatic prohibited transaction. So any financing inside the IRA has to be non-recourse. So that limits you, because a lot of lenders won't touch a non-recourse debt nowadays. If you finance property inside of an IRA, you're going to have UDFI, unrelated debt finance income. So as an example, just to make it simple, let's say you buy an asset in an IRA. Let's say it's real estate. You buy it for $100,000. You put $50,000 cash down, and you put $50,000 debt on the loan. So your IRA borrows $50,000 from a bank on a non-recourse basis. The IRA asset value doubles. So now it's worth $200,000 and you sell it. You've got a $100,000 gain. 50% of that gain will be taxable because you financed it or leveraged it by 50%. So you now have to file a 990T tax return and pay tax on 50% of your gain. So you'll find most people who buy real estate inside the IRA will not use leverage. It's really an all cash deal. It doesn't hurt the IRA to do it. You just have to remember you're going to file a 990T and you may end up paying taxes, through the IRA. So here's a quick summary. What if you're, two more. So this is one, what if your IRA runs out of cash? You're investing in real estate, you're investing in a limited partnership, you have a cash call, your real estate has all sorts of maintenance issues. You have to pay those bills out of the IRA. If it runs out of cash, you've got an issue. You cannot use personal cash to cover the maintenance. That's a prohibited transaction. So the IRA is going to have to pay for all the maintenance costs. There are ways to deal with that. It may be you have to sell some assets to generate cash inside the IRA. It may be you have to make another annual IRA contribution. You may have to make an excess contribution above and beyond what the limit is, and there's a penalty for that, but sometimes you have no choice. So be very careful when you're doing alternative assets in your IRA. You have to have enough liquidity to cover any maintenance demands that may come up, et cetera. So just keep that in mind. That's a big one. And so really getting started, you want to choose, what are your investments? What do you want to invest in? Once you've answered that question, then the next question is, what provider do you want to work with that specializes in that area? And then you can move the IRA to whomever your specialist is. You're going to authorize the IRA custodian to proceed. Remember, you're not the owner, your IRA is the owner. So you want to make sure that all of the documents are executed by your custodian. And finally, all cash flow, revenue coming in, expenses going out, everything has to go through the IRA. And that is a whirlwind tour on self-directed IRAs. I'll turn it back over to Doug.
All right, Bill. Well, that was a whirlwind tour. Great information as usual. We have some questions. So let's go ahead and open it up to questions. Again, you have Bill's contact information on the screen, and we'll be sending that out after, but let's go ahead and open questions now.
Yes, so Bill, it seems we have another live questions that came in that asks, if you have a 401k, can you set up a self-directed IRA?
Good question. Yes. So you could certainly have both. So if you already have a 401k plan, you can absolutely set up an IRA. The real question is, if you set up a traditional IRA, is the contribution to the IRA deductible? If you currently have a 401k plan, the answer is the contribution to the traditional IRA is probably not deductible, but it doesn't mean you can't make the contribution. So I'm the perfect example. We have a 401k plan here, and I contribute to that. So I do have a traditional IRA. I make a contribution every year to the traditional IRA, but I cannot deduct it on my tax return because I have the 401k plan. So you can have both. You just have to meet with your tax advisor and see what you qualify for. If you're doing a non-deductible contribution, there is a form your tax advisor will complete with your tax return every year, and that documents what portion of the contributions are non-deductible, meaning you're starting to build up a basis in your IRA. So that will not be taxable in the future as you pull funds out. Some of that basis will offset the tax liability.
Thank you for that answer, Bill. We have received some questions from attendees at registration as well, so let's go through some of those as more live questions come in. Okay, so the first one, if one buys a piece of real estate through the self-directed IRA, can one withdraw rental income without penalties?
Good question. No. Well, let me back up. So if you've made the investment in the IRA, you've bought real estate, rental income is coming in. If you take the money out, or if you have the rental income paid directly to you, that's probably a prohibited transaction and it will cause issues for the IRA. However, the money comes into the IRA as rental income. The trust company credits your IRA for rental income received. Now it's cash in your IRA. At that point, you go to the basic distribution rules. So if you're 59 1/2 or older, you can always take money out of your IRA without a penalty. If you're under 59 1/2, you may have a 10% penalty for pulling cash out of your IRA. So the answer is it depends. It depends on your age. It depends on what you qualify for distributions. If you're over 70 1/2, actually that's been changed now. They bumped it up. If you pass the required minimum distribution range, you're going to have to take some out. So it really depends on your situation. So the answer is if you pull it out, yes, you can do it. Maybe penalties, maybe taxable, may not be taxable. It depends on the situation.
Thank you. Let's take on the next question. So can one easily convert his or her profit plan with only one person in it to a self-directed IRA? Any advice on where to start from?
Good question. So yes, if you have a 401k or pension plan or something like that, you probably have retained the services of a plan administrator. And so that's where I would start, because you're really looking at terminating your current plan. And then part of that termination and winding up the current plan is rolling over or distributing the assets to a self-directed IRA. So that can absolutely be done. A lot of people do that because the costs involved with a one-person or two-person 401k can get a little expensive every year, and roll it into a self-directed IRA might save a lot of costs. There's also a trade-off though, so it depends on the state you're located in. Some states have made it easier in litigation situations where they can go, creditors can go after self-directed IRAs. It's very difficult to go after a 401k or pension plan. So talk to your attorney in that regard to see whether you want to keep the 401k for asset protection, or if you want to go to the self-directed IRA for other reasons, costs and more flexibility, et cetera. Some states have not done that, but just talk to your attorney to see what they think.
Appreciate that response. So the last one is, can you share some of the most common mistakes people make with their IRAs and the best strategies to avoid those mistakes?
Good question. Yes. In fact, the most common mistakes are the prohibited transactions. Because a lot of people don't know what they don't know, and we don't know what they don't know. And if they don't call and ask, can I do this, then there's no way to tell them you can't do that. And so what we see a lot of cases is prohibited transactions where the investor has bought an asset inside the IRA, and then all of a sudden the monthly cash flow starts going into their personal checking account. And now you have a prohibited transaction that's very difficult to clean up. So things like that are the most common types of errors, and they just don't think about it. They think, well, this is my IRA, it's my property, it's my rent, so why can't I keep it? But they're creating a huge audit issue when they're caught. And it's also very expensive to fix that because you have to work with the IRS and the Department of Labor to clean that mess up.
Got it. So definitely seek professional consultation on dealing with an IRA account. And we encourage everyone who has remaining questions to contact Bill, and so he can address things in more personal details. I believe that's a wrap for the Q&A session today. And thank you, Bill, for entertaining all of our questions.
You're welcome. My pleasure.
Back to you, Doug.
Wonderful. Thank you, Paris. There were a few more questions, Bill, but we could probably get those forwarded to you since we're running out of time, and you could answer them at that time if that's okay with you.
Sure, absolutely.
Wonderful. Well, I want to thank Bill on behalf of CCIM San Diego. Wonderful presentation this morning. Answered a lot of questions I had about self-directed IRAs. So thank you so much. And I'm sure everybody got a lot out of this presentation. If you want more information about Bill and his company, go to his website, www.exeter1031.com, exeter1031.com. Or again, you can reach out to us and we'll be happy to get you his contact information and find out more about our next event, which coming up on September 15th is going to be a presentation on Prop 15. Prop 15 is going to be discussed on September 15th. Certainly something you want to take a look at, and also take a look at our additional events at CCIM San Diego website, or of course our LinkedIn event page. And we look forward to seeing you real soon. So be well, have a successful week, everyone, and we'll see you on September 15th.